everyone. It's really amazing to be here. And welcome to our panel about liquidity events, secondary sales, and employee stock options. My name is Kaisa Luht, as was mentioned. I am currently the reward lead in Salto X, where we help growing companies manage their equity on an easy-to-use platform. So if you need any help with your employee stock options or any other kind of equity, then find me later or add me on LinkedIn. Before Salto X, I worked in Wise for what seems to be a very long time. And I took care of everything employee stock options related, including doing some of their secondary sales. And I presume that is the main reason why I was asked to moderate this lovely panel here today. So without any further ado, let me introduce my amazing panelists here. We have Ben Barclay, who is the head of strategy and M&As from Zendesk. We have Frederic Leibundgut, the executive director from UBS. And we have Daniel Frese, who is the co-founder of Pexels. May I ask all of you to also say a few more words about yourselves, just so the audience gets to know you? Ben, would you like to start?
Sure. As Kaisa said, I'm Ben. I've been at Zendesk now for the better part of a decade. We have been super active from an M&A perspective in the European landscape. This year, we actually bought both an Estonian and a Helsinki-based company, or a couple of companies. And so it's great to be at this event and discover more of the broader ecosystem.
Frederic?
Thanks for having me. Look, I've spent about a decade with the group now, and a lot of what we do is focus in transactions with tech and growth companies, and within that, specifically Nordics and Baltics are very core. So it's great to be here and sort of talk through that narrative.
And Daniel?
Yeah, hello everyone. I'm Daniel. I think we have an interesting story because we bootstrapped a company, Pexels, the free stock photo marketplace. And then after a few years, sold it to Canva. So after bootstrapping, joining a VC backed rocket ship. And then ran Pexels for 6 years, so under Canva.
That's an amazing story that we will hear more about soon. Before we get into the deeper discussion on M&As and other liquidity events, I thought I don't really know how much you all know about liquidity events or what they even are, so maybe I'll just mention what these acronyms stand for. We have M&As, which are mergers and acquisitions, but in simple terms, it just means one company being sold to another company. We have secondary sales, which are becoming more and more popular, but basically they are existing company shares being sold to new or existing investors. And then we have this fancy word IPO, which stands for initial public offering. But again, just a very complicated word, which means that the company is going to become a public company and everyone in the world can buy its shares. But Frederic, you work with growth stage companies on their liquidity strategies. How do you see the current liquidity environment in Europe?
Right, so let's pick on these capital raising and then M&A. If we look at M&A, if Q1 a year ago, 23 was the low point, in this year we're up 44%. So that's meaningful swing towards, I think, what we've seen pre-2021, which was an outlier. So you see a lot of activity. And then what underpins that is just because it's been a bit slow over the past years. There's still, I would say, in global VC and the way we look at it, there's about 400 billion-ish of capital that needs to be allocated over the next 3 years. So we would expect transactions and liquidity to make a pretty robust comeback this year. And we're starting to seeing this now.
That's really good news. And Ben, Zendesk is a US company, but you acquire a lot of European companies. How do you see the current market here in terms of its attractiveness? And why does a US company want to acquire European companies and not US ones?
Yeah, I mean, there's fantastic talent in Europe at a great cost basis, and we think that there's really interesting new companies that are especially embracing generative AI that are being built here in Europe. And so, given that so many of our customers are in Europe, so many of our existing employees are in Europe, for us, we're really excited to be acquisitive here, and look forward to doing more of it. I'd say, more broadly speaking, as talking with peers in the U.S., I think they're also coming around to the idea of Europe. And expect to be more acquisitive, as Frederic's data suggests, now that there's more certainty in the market around where we're headed with interest rates, where we're headed geopolitically. There's always risk, there's always uncertainty, but I think buyers are feeling more confident in the kind of the ground beneath their feet right now.
And would you say that you're finding more AI-oriented talent than in Europe than in US? Like, are we ahead in that?
I mean, it's a hot space, and there's still amazing AI companies being built in the United States, and the folks are moving over to the United States to work at them. But from certainly on a value for money basis, as well as finding talent who are concentrated in specific pockets within the European continent. We're pretty excited about what's here.
Yeah, Daniel?
There's an interesting fact. If I'm counting correctly, then Canva bought 8 companies in their lifetime, and 7 of them they bought from Europe. They didn't buy any companies in the US. They bought 1 in Australia. But Europe, for them, it seems to be really, really interesting because there's great people. And in some sense, also good prices if they want to buy companies. Yeah, it makes a lot of sense. So a lot of these really big, successful companies are looking at Europe.
That's really amazing. Means we are at a very great place to be to create more and more successful companies. And Frederic, do you agree with Ben's point of view in regards to Europe and especially to Baltics?
Yeah, I think, look, we've sort of seen probably the first wave, which pretty much established the ecosystem here. Then it got a bit quieter, but now when you speak to investors, and we do this globally, I think for the past 12 months or so, Baltics are like a specific focus that people want to gain access to. And then I think to Ben's point, M&A and sort of bringing your growth company onto a bigger platform is something that's gained a lot more acceptance across sort of both founders, but also funds and the way you think about your sort of that journey. I think M&A, also our thesis, will play a key role in terms of liquidity. So gone are the days where you're just thinking, I need to grow this company from 0 to IPO. But I think any option in between and any combination, which makes sense for both sides, is sort of what we would focus on for the next few years.
And you said that investors are trying to gain access to the Baltics. Is that something that's difficult, or what are the obstacles?
It's probably one for Ben to answer.
So I think that it's not. I mean, of course, there's a handful of public companies in the Baltics and in the technology space, and we all know them, and those are accessible. I'd say that with my American perspective hat on, there's still more market awareness that needs to be built. Right, I was having dinner actually on Tuesday with not an American, but working at a European investment firm, and he had a lot of trepidation about investing in the Baltics because of the relative shallowness of the capital base here, as well as just some geopolitical risk. And so I do think that there's probably more of an opportunity for from a policy perspective and from a promotion perspective to highlight what's going on here.
Okay, thank you.
So on that note, I think if you compare, I don't know, take the German ecosystem, you're just a lot more geared towards having discussions with investors. What we see here is great teams with great products and sales and what have you. But as soon as that dialogue moves to speaking to investors, there's a bit less preparedness here.
So they're not
so that
just
might
prepared?
be the one in terms of, transparency and sort of having your data ready to not just have a conversation, but to steer that into deal making. And it goes a bit into Ben's theme there. I think you just need to do that more often and sort of be a bit more aggressive around that as well. But the opportunity is certainly there.
Great. Daniel, you're a founder yourself, like probably many are in the audience, and you decided to sell your very successful company, Pexels, to Canva. Why did you do that? And what was the best thing that came out of that event?
We didn't want to sell our company, so we got some emails from time to time from other companies inquiring about selling Pexels to them, but we always said no. And the reason why we spoke to Canva was because we knew Canva, and we thought that this is a really interesting company. And then when we talked to them, we realized, yes, that's actually true, because they have an amazing team, their numbers just looked amazing. And then in the end, the decision to sell the company was not that we wanted to sell our company, but we did not want to miss the opportunity to be part of Canva and not regret that we would see on TechCrunch every year how well Canva is doing, and they're getting bigger and bigger, and then we're not part of it. So in some sense, this happened because of Canva and not because we wanted to sell the company.
You saw a great opportunity and took it. Yeah. Ben, you know M&As more from the buyer's side. How does an M&A actually work? We all know there's a lot of legal complexity behind it, but what does it mean for employees? What happens to their options, vested or unvested? Like, could they lose all their options because they're not yet shareholders, or what?
Yeah, I mean, the short answer is it depends. It is very much subject to what the buyer and seller agree, and legally put into a purchase agreement and some of the ancillary documents. I think in general, though, option holders who have vested some of their options, those are treated as equity, as long as, or like equity, as long as they're in the money. And then, certainly for, and we can kind of go into some of the more specifics, but RSUs and so on, those tend to also have been vested. The unvested stock, whether options, RSUs, what have you, it is a deal point. And so when you're selling your company, you need to think about kind of what can be a pretty meaningful amount of proceeds that can go to your employees, and how you want that to be treated, right? Typically, the buyer is going to have an opinion. Often that opinion is to cancel those unvested options or to roll them into their existing incentive program. But again, it is a subject into negotiation, and there are pros and there are cons, right? Chances are a lot of that liquidity is going to come out of founder liquidity, right? Because the purchase consideration isn't going to change. We're just going to divide the pie a little bit differently. And then, when you do sell your company, there's often other deal points like transaction bonuses, retention bonuses, et cetera, for key personnel within the company that you're selling. And you also have to be thoughtful around, you're giving new career pathways to so many folks in your company, and those career pathways come with new salaries and new reporting lines, and being able to participate if it's a public company and the employee stock purchase program and so on. So I'd say really avail yourself when you're selling your company around what the acquirer programs are, what their intentions are, and broaden the size of the deal pie to certainly make what's best for you, but also to solve for some of your employees.
Okay, and Frederic, do you want to add anything to the perspective on M&As?
Yeah, I mean, from an employee perspective, and here we're talking about growth. Look, when you do M&A and sort of with mature companies, that becomes a synergy play quite quickly. Here, I think you bring platforms together to grow. So in general, buyers are really interested in keeping those or retaining those employees for the long run. So granted, different structures and different options, but as a theme, you want to keep and retain those employees.
And how do investors see a company selling their company? So a founder wanting to sell their company. Like, is that something?
Outright, as in
like is that something? Okay, they're not that confident in their company anymore, or like, is it a positive sign for investors that a founder wants to sell?
And this is like in a secondary, you think more?
I mean more of an M&A, as in selling
M&A.
their own company.
Got it.
Look, I think M&A is part of venture capital as much as it's ever been. And then investors want to see liquidity as well, have to see liquidity in order to reinvest again. So, no, I think if anything, M&A is to be seen as a success and not as a failure or loss of confidence whatsoever.
Okay.
It's an exit path.
Good. When we go more to the secondary side of things, then you probably see, of all of us on the stage, the investor side of it the most. How interested would you say that investors currently are in buying employee shares and founder shares?
So this is, for us, when we speak to investors, this is on every agenda. Every conversation is around, look, and it goes a bit to the point where we had not enough transaction activity, not enough liquidity for a while, and people want to allocate. There's a lot of, fantastic companies that have worked through the cycle. Now they don't need capital as a result of getting more efficient through that. And getting access now into those companies, sort of very much top of mind for a lot of investors. And then the other bit that's changed quite drastically, and again, as a function of sort of dampened activity, is the days where secondary had some sort of stigma attached to it, where it was looked as loss of confidence, completely gone, right? Everybody recognizes that there's employees who might, need to buy houses, have kids, whatever it might be. So it's something completely detached from a company valuation. It's more of an individual situation. And hence, so we see a lot of this, a lot of activity from super small deal sizes to larger tickets. And that is really something that's becoming a mature asset class, much like it has been in private equity as well.
That's really good news for everyone wanting to do secondary sales. And I'm sure there's founders in the audience who are thinking like, maybe I should do this as well. How should they go about finding investors for their secondary sale? I think,
not to repeat Ben, but it depends is also the answer here. The question is a bit, how does that current transaction tie into the bigger picture? Because we see a lot of primary investors that also are picking up secondaries in great companies. But so there's people that can do both. And usually what we find is, one, they speak the same language. They don't come in from sort of a valuation discount perspective, but just they want to gain access. But it can also double down. So ideally, if you find a number of employees, maybe the founders to some extent, and you find, you know, an interesting size, whatever that might be, that gives you any possibility to bring great investors on board. And I think there's a ton of funds out there that really understand both ends, and then can, you know, not just give you liquidity, but also sort of be super valuable for the company and its board.
I hope founders got some tips from here. Now, Daniel, when you sold your company to Canva, employees were also able to get some cash. But how did you first decide that you wanted to give options or equity to your employees? Was it an easy process setting up your option plans, and how did you go about it?
We decided to give out stock because, first of all, it's the right thing to do. And we also heard from other founders that this is impacting the company culture, and it's a really good thing to do. And we learned that this is completely true. If you hit milestones every 6 months, 12 months, and you celebrate with your team, then it's completely different if everyone knows that they are part of it and everyone can become successful together. It's very different than if you don't do that. Like, then
Absolutely.
your team will be like, yeah, congrats. But yeah, if everyone's part of it, it's very different, and it's really, really nice. You know that you help the people that you have in your team and that you like and that you work with and that you spend so much time together, that they will also be doing really well.
And how easy was it to set up the option plan for your employees?
We decided to give out shares, but then it took about 1.5 to 2 years for us to actually start moving on it, because we have had a remote team in a lot of different countries, and as a German company, it was really not so easy to give out shares to so many people across the world. But then the acquisition with Canva happened, and then as part of this, we gave everyone what we promised them. So actually for 1 to 2 years, we did not have a contract with our team saying that they will receive the stock, but more just like a verbal commitment, because we just didn't know how to create this legal framework.
So you were an amazing founder. Your employees didn't actually have any contracts with you, just a verbal promise, but you still delivered them what you promised.
Yeah, I mean, if you don't do that, I think that's really bad. Yeah.
We are slowly starting to run out of time, so I will ask you all one fun question, and then we have also a question from the audience. What is the one thing you would like people in the audience to walk away with from this chat today? Maybe a point you would like to emphasize, or some advice you would like to give? You know, Ben, maybe you'd like to go first?
Sure, yeah. I mean, self-serving, but I'd say probabilistically, more so in Europe than in the United States, but everywhere, you know, the most likely liquidity event for your company is M&A. And you can start making very conscious decisions around how at some point, you know, won't necessarily be tomorrow, might not even be next year, that the company will be sold. And think through how that can permeate in many ways, you know, all aspects of your company, from the design of your stock option program and the triggers and what have you within that, to company culture, to how you as a founder spend your time cultivating relationships with prospective, you know, someone who may buy you at some point. And I think that you know that's operating in your fiduciary duty as a founder, right? You're trying, you know, you will at one point get liquidity for your investors and for yourself, but I think that it's also just the nature of the ball game.
Okay. Before I get to two of you, I will quickly ask the audience question, because only 1 minute left. Daniel, what is the biggest misconception you have ever had about the exit process and/or post-exit integration?
Sorry, the what?
What's the biggest misconception that you had about the exit process of the acquisition of your company? Did anything surprise you?
That it would be really complicated and take a very long time. And in our case, it was very quick. We had a tough negotiation, but from that first email from Canva to the signature was 2 months. And we had one main lawyer that we worked with, one person, and that's it. And it was actually not that crazy or complicated, and it was even a lot of fun.
We have one more question. Can you share some typical examples of ESOP percentage given out to employees? Alerts, best practice advice. I mean, I can answer that, but would any of you like to answer that? This depends on the status or stage of your startup, whether you want to give out a percentage if you're at the very early stage, or if you're already, your shares are a bit more valuable and you have a fair market value to your price, then you can give out certain value amount of options. In terms of your cap table, the recommended amount is 5 to 15% that you should reserve for your employees if you want to go down that route. I don't know, does any of you want to contradict me or give best practice that you've seen? No? Okay. We are out of time. And I would like to thank all of you for coming here today and listening to us. And I hope you got some great insights. And thank you all to all of my amazing panelists. So, thank you.